Good morning and welcome to Morning Markets. Today we're going to be focusing on the labour report from the UK and wages. Key focus today is on the UK labour market report and wage growth released from the ONS. We'll be focusing on what the key points were from the report, what this means for the UK economy and how the market has reacted. The key points from the report was that wages grew faster than anticipated. When we look at total pay, including bonuses, that increased from 7.2% to 8.2%, so much higher than expected. 7.3% was the forecast. When we look at pay, regular pay, excluding bonuses, again, we saw very strong wage growth, increasing from coming in at 7.8%, again, higher than expected. When we look at the unemployment rate, that also increased from 4% to 4.2%. And we look at the labour participation rate, that also fell from 76% to 75.7%. And job vacancies was also weaker, a 13th consecutive month, but still above 1 million. In terms of what does the data tell us? Well, it means that the wage growth continues to be very strong. The risk is that means that inflation will be higher for longer and inconsistent with the 2% target rate set by the Bank of England. It has been a problem for the Bank of England in previous months, higher wage growth and higher inflation, and therefore they've responded by higher interest rates. This does risk that interest rates have to go up in the future, given the stronger wage numbers today. In terms of where that wage growth is coming from, a lot of it is coming from the public sector. You've seen large one-off payments to NHS workers, which has contributed in the data today. Unemployment is rising, but it still remains historically low as companies have to continue to pay up for higher wages to retain and attract workers. One of the positives is that the ratio of job vacancies to unemployed workers has continued to moderate, meaning that it is becoming a little bit easier for companies to hire staff and therefore should help ease wage growth in the future. In terms of the economic impact, it does mean that interest rates are likely to go up higher in the future, but higher wage growth is a positive when it comes to thinking about consumer spending, especially when you've got wage growth higher than what inflation is today. We've got wage growth, including bonuses, at 8.2%. That's higher than the current reading of inflation at 7.9%. We're expecting tomorrow inflation to fall further from 7.9% to 6.7%, so that gap between wage growth and inflation should widen and again help facilitate future consumer spending in the future. When we think about the market reaction, we'll look at equities, slightly weaker this morning, but when we look at currencies in terms of the pound, that was slightly stronger, although flat against the US dollar. The real movement was in the government bond market, the UK gilt market, where we saw some weakness with government bond yields having to move higher to really price in the expectation that interest rates have to go higher in the future and inflation may be slightly stronger or stickier in the future as well. That's everything from us today. Thank you for watching and we'll see you tomorrow.